Good evening, guys. Today it is 9th of May, and I'm recording this video regarding the market situation that is panning out presently. So, I would discuss bunch of things with you guys regarding how the market is responding on the backdrop of the US-Iran war, as well as the earnings that are gradually being reported by the companies in their quarter 4 of the financial year 2026. Now, as we know, market is market was kind of in a panic mode on March of 26, and it made sort of bottom on end of March, and since then there has been a non-stop rally by the, especially from the mid small cap as well as micro cap in the sector. Even though the even though the problem that was the main cause of the market fall, that is the US-Iran war, has not come to a conclusive end. The market is kind of, you know, market is kind of pricing it, expecting that the negotiation between the US as well as US and the Iran through through the intermediation of third party, namely Pakistan and other countries, that agreement or memorandum of understanding that is being called will come to place very soon. The market is railing on that expectation, and this is the overhang that we may say that is present in the market, even though the rally is still continuing, and market hasn't given any sharp fall since the rally began on initial days of April. So what is the scenario that looks like from here on? So I would say the overhang that I have just discussed, uh, as long as it persists and as long as the crude oil price remain elevated due to that overhang, the market can never be sure about the consequences of the war, because the kind of tone from Donald Trump and dictation that he announces from time to time to Iran, and also the firm-footed approach that we see from the Iranian side, even though they have been subjected to immense pressure, both militarily as well as economically. The you know any kind of result, any kind of positive result that the market is expecting is not that easy, that we know for sure. So what to do? So as I always say, in equity market, you should never be out of the market, even if the market is falling as well as even if market is rising. Only you can play the valuation game. So you have to check the companies where you are investing, and accordingly bet diversifyingly, and let the market do its own course. So if the positive news that the market is expecting, that I have just mentioned, even if it doesn't come, it doesn't mean that you need to sell all your shares and completely come to cash before any kind of positive development uh, happens, because market doesn't give any chance for anyone to enter. Remember how the panic mentality that we that we were having on the last days of March, when the so-called nuclear threat from US to Iran was being discussed, and everyone was so negative about the outcome of the war that that the that no one was thinking to buy the shares, because they were all expecting some kind of, you know, ever greater uh, ever greater ever greater kind of mishap that may happen in the Gulf countries following the nuclear threat. So this is how the game plays in the market. You won't be able to buy when the market is low, because your psychology won't allow. And one more thing, yeah, there won't be much cash also left with you to buy. And even if you have the cash, market won't give you any that courage as well as time before it just moves up, as we have seen. So as a retail investor, the only thing that we uh, have in our hand is to just focus on the companies that we are investing, and just focus on the valuation part, especially the future cash flow that the company is expected to generate. Because even if the companies have been doing greatly in the recent years, it doesn't guarantee that the future numbers from the companies would, you know would be similar. So how to be sure that the companies that we are looking for, the companies that we are investing, uh, are good, are also available at a reasonable price even after the rally that we have seen, as and they would not, you know and they would they would be giving a good set of numbers in the in the coming years to come. So there are you know there are a set of things that I will discuss in the coming videos about the factors that we must, emphasize or look for before choosing the companies for a long-term investment, say for 3 to 5 or maybe 10 years down the line. Hmm, so one thing I have seen, as we have discussed in our previous videos, that we see tremendous set of rally in the small and micro cap companies, say 40-50% of growth, yearly growth in their number, that may continue till they become a mid-sized company. And when they become a larger player, the growth momentum generally slows down. Typical example of which is, I would say, a trend. The share price we can observe is that it is continuously falling, even though the company is reporting growth in their number, lesser it may be compared to their previous ones, but the company's share price is decreasing. One reason for that obviously is their valuation. That is, they are trading at a double digit multiple. So double digit multiple, but it was also trading at even higher multiple when the bull run was going on in 22 to 25, 2022 to 2025, you know and the stock price went up to 8,000 probably. So why that particular thing happens? because we have to see the valuation in conjunction to the result. Company is reporting say 20% growth and it is trading at 90p. That price won't be sustainable, as we all know. A 20% growth company, however sound the company's balance sheet may be, it cannot be traded at a multiple of 90. Market would definitely bring the price of trend further down. Even if it doesn't bring the price back, bring the price down, it would consolidate at that price range where it is trading, because the valuation or the because the growth doesn't support. Also, market knows their company won't cease to exist because the company is great as and their balance sheet is great, and it would definitely keep on working for a long period of time. So the discounted cash flow of the company, we can calculate, is will be for a very long period of time. So as I was discussing, the more the company becomes, the larger the company becomes, the growth rate slows down. So how to avoid this trap? For me, the only thing that you know seems logical is buy some financial sector companies like we see Bajaj Finance company, which is currently standing at a valuation of around 5 lakh crore market cap, and yet it is trading, it is able to post 20-25% growth year after year, even after being that big large cap company. So this is a big takeaway. This should serve a big takeaway from for us, to for which sector we should look for a sustained growth. It is a company which can grow year after year with a decent, year after year, without thinking about its size. So the financial sector is one such sector, because in imagine you have 1 crore of liquid cash in your hand, and you start announcing that you are supposed to disburse those cashes as loan from sorry, from tomorrow, from your house. You won't have any dearth of customer that would be lining up in front of your house. And similarly, imagine instead of 1 crore, you now have 10 crore. You may face difficulty in disbursing those cash single-handedly, but if you hire 2 or 3 people and use those manpower to disburse 10 crore of capital, that exercise can be performed with as uh, with as surety as you performed while dispersing 1 crore of cash. So financial sector, the size doesn't cause any sort of difficulty for the company to grow in future, with a higher pace on a large base. The only thing that required for the financial company to keep on reporting good set of numbers is the overall macroeconomic condition. So presently we see the NBFCs, be it the housing finance companies, MSME lender, say, like Five Star and all those companies, they are trading at a relatively lower multiple in terms of the price to book ratio, and those companies are can be a true multi-bagger if the macroeconomic set of environment allows those company to grow, and the management from the company's end remains strong. So it is a niche segment where the dearth of where the TAM, that is total addressable market, is huge, and it won't come down at any point of time in the future. That market would still remain, even if a war happen, even if some kind of natural calamity happens, like the kind of one we saw in COVID. The need for the loan, for MSME loan or housing finance loan or any personal loan that that the NBFC provides, that won't go down. So this is one set of one sort of segment that we can look for a very long horizon of time, say 10 years, 20 years down the line, where the dearth of demand is where there is no dearth of demand, and companies with a strong balance sheet can keep on compounding our money for a long time. So in the next video we would discuss some other segments, and where we can, and also we'll discuss how we can you know how we can align our mindset in those sector for a you know in those sector, like the one we have just discussed, and find a potential multibagger in those sectors as well. So till then, thank you guys.